Most families don't lose their wealth because they didn't work hard enough. They lose it because nobody told them how money actually moves from one generation to the next. And by the time they find out, it's too late. I'm GeraldTalks, and I've spent years watching families receive inheritances that changed their lives for the better. And just as many watching inheritances tear families apart, drain bank accounts, and create courtroom battles that nobody saw coming. So today, I want to give you the full picture. The 6 smartest assets you can pass on or receive, and the 6 that look like gifts but function more like traps. Because the difference between leaving your family freedom and leaving them a financial disaster often comes down to what you own and how you own it. Let's start with number 1 on the best side, and that's cash. I know, cash sounds boring, and that's precisely the point. When someone passes away, the family is already dealing with grief, paperwork, funeral arrangements, mortgage payments, and 1,000 other things demanding their attention immediately. Cash doesn't require an appraisal, doesn't need a buyer, doesn't spark arguments over who gets what, and doesn't come with a monthly maintenance bill attached to it. It is pure, immediate flexibility. And flexibility is exactly what a grieving family needs most. Sitting across from cash on the worst side is the timeshare, which is essentially the financial world's version of a gift nobody asked for and nobody can return. Inheriting a timeshare doesn't mean inheriting a vacation. It means inheriting annual maintenance fees, usage restrictions, a nearly impossible resale market, and the sinking realization that you're now financially obligated to something you didn't choose and can't easily escape. Families have literally paid companies to take timeshares off their hands because the ongoing costs outweigh any possible benefit. And that is the exact opposite of what an inheritance should do for the people you love. Moving to number 2 on the best side, life insurance stands out as one of the cleanest, fastest assets you can pass down, because it arrives exactly when the family needs it most, quickly, directly, and without the complications that surround most other asset types. It doesn't go through probate, it doesn't require an appraisal, it doesn't get tangled up in estate negotiations, and the beneficiary can use it for literally anything. Covering debts, paying taxes, handling living expenses, or simply buying the family a few months of breathing room while everything else gets sorted out. The speed of life insurance is not a small thing. When someone passes, time becomes a resource almost as precious as money. Now flip that coin and you get collectibles as the number 2 worst. And I want to be fair. Some collections are genuinely impressive and carry real value on paper. But in practice, inheriting a room full of rare coins, vintage firearms, specialty memorabilia, a classic car that needs storage, or a boat sitting in a marina across the country, turns your heirs into amateur estate dealers at the worst possible moment in their lives. They need appraisals from experts they've never met, storage they have to pay for, insurance on items they don't fully understand, and buyers who know they're in a position of pressure and will negotiate accordingly. GeraldTalks has seen estates drag on for months, sometimes over a year, simply because of a few high-profile collectibles that were difficult to value and nearly impossible to move at a fair price. The collection that felt like a treasure becomes a project, and nobody signs up to receive a project as an inheritance. Number 3 on the best list is appreciated brokerage assets, stocks, mutual funds, index funds, specifically when they're transferred at death rather than sold beforehand. And the reason comes down to one of the most powerful and underused concepts in estate planning, the step-up in basis. Here's how it works in plain terms. If someone bought shares of a company for $50,000 and those shares grew to $300,000 by the time they passed, that $250,000 gain essentially disappears for tax purposes when inherited. The heir's cost basis becomes the value at the date of death, meaning they could sell those shares the next day and owe nothing in capital gains tax. That is an enormous benefit that most people don't fully appreciate until they see the numbers side by side. Now flip that to the worst version, which is when someone sells those appreciated assets before passing. Maybe to simplify things, maybe because they think cash is cleaner, and pays the capital gains tax voluntarily, reducing the total wealth transferred for no real benefit when the step-up would have handled it automatically. It's one of the most common and costly planning mistakes that happens not out of greed or negligence, but simply out of not knowing. And that's what makes it so frustrating to see. Number 4 on the best side is real estate with a plan, and the emphasis on those last 3 words is everything. Appreciated real estate receives the same step-up in basis at death that brokerage assets do, which can eliminate massive amounts of embedded capital gains and give heirs an incredible starting position. But beyond the tax benefit, real estate with a clear structure, a living trust, a holding entity, written instructions about whether the property gets sold, kept, rented, or distributed, transforms what could be a conflict into a gift. The best version of this looks like a parent who sat down, thought about which child loves the mountain cabin and which would rather have cash, documented those wishes, and built the legal structure to carry them out smoothly. The worst version, sitting right across from it, is a vacation property or shared real estate with multiple heirs, no written plan, no legal framework, and no conversation about what should happen next. One sibling wants to sell, one wants to keep it forever, one can't afford the property taxes, one lives nearby and feels entitled to use it more. And all of them are grieving while simultaneously being forced to negotiate like business partners over an asset that's generating costs every single month. GeraldTalks has watched beautiful family relationships get shattered over a beach house that nobody could agree on. And the saddest part is that it was entirely preventable with a single afternoon of planning. Number 5 best is the Roth IRA, or Roth account of any kind, because the tax treatment for the person who inherits it is simply cleaner. The money inside a Roth has already been taxed, which means distributions typically come out income tax-free, and while there are still rules around timing and required distributions for non-spouse beneficiaries, the fundamental math is far more favorable than the alternative. When you inherit a Roth, what you see is largely what you get. Contrast that with the number 5 worst, the traditional IRA or pre-tax retirement account, which looks impressive from the outside, but carries a hidden tax liability inside every single dollar. The beneficiary who inherits a traditional IRA isn't inheriting the full balance. They're inheriting the balance minus whatever income taxes will be owed when they take distributions. And depending on their tax bracket and the size of the account, that difference can be staggering. A $100,000 traditional IRA and a $100,000 Roth IRA look identical on a balance sheet and feel completely different when it's actually time to spend the money. And that gap is why thoughtful retirement account planning matters so much more than most people realize. Finally, number 6 best is a family business with a true succession plan. A documented, legally structured, operationally clear plan that answers the hard questions before they become emergencies. Who manages the business when the founder is gone? Who has voting rights? What happens if one child works in the business full-time and the other 2 live across the country and want nothing to do with operations, but still want their share of the value? A business with answers to those questions can be a generational asset, a legacy that keeps producing wealth and opportunity for decades. Without those answers, the same business becomes number 6 worst. A family business with no succession plan. And the cost of that gap shows up immediately and brutally. Payroll still has to be met. Customers still need to be served. Decisions still have to be made. Vendors, employees, partners, and creditors don't pause because the owner passed away. And a family that is grieving and simultaneously trying to run an operation they may not fully understand is a family that is heading towards serious financial and relational damage in a very short amount of time. So when you zoom out and look at all 6 pairs together, the pattern is clear. The best assets share certain qualities. They transfer quickly. They carry minimal tax friction. They're easy to divide fairly, and they come with clarity built in. The worst assets share the opposite qualities. They're illiquid, expensive to maintain, difficult to value, and almost always made worse by the absence of a plan. And here's what GeraldTalks sees over and over again. Families who actually do the work to start planning often stop short of finishing. They set up a trust but never fund it. They own a business but never document a succession strategy. They have appreciated assets and then, right near the end, sell everything and trigger a tax bill that proper planning would have eliminated entirely. They add a child to the title of a home, thinking it will simplify things, not realizing they've just converted a step-up in basis opportunity into a taxable gift. They leave a property to 3 kids with nothing but love and good intentions and no roadmap, and they trust that the family will figure it out. And sometimes they do, but often they don't, and the cost is measured not just in dollars, but in relationships that don't recover. The real question you should be asking isn't, what's the most valuable thing I can leave behind? It's what gives the people I love the best outcome after taxes, logistics, and real life show up at the same time. Because the greatest inheritance isn't the largest one. It's the one that keeps your family intact, keeps more of the wealth in their hands, and gives them the freedom to move forward instead of the burden of cleaning up a mess. That's what legacy actually means. And that's exactly what GeraldTalks is here to help you build.